introduce our very first speaker for today, a leading economist here in the Philippines, Dr. Luis Dumlao. Dr. Luis Dumlao is the Dean of the John Gokongwei School of Management, an associate professor at the Department of Economics of the Ateneo de Manila University, and a senior fellow of the Ateneo Center for Economic Research and Development. Here now with his presentation, The State of the Economy Entering New Possibilities, let us all welcome Dr. Luis Dumlao.
So good afternoon. I'm here to speak about the state of the economy entering new possibilities. As we all know or notice, the pandemic seems to be dwindling down. Then new possibilities come and new challenges come with what's going on in Eastern Europe. Let me share the outline of my presentation. I'll skip some of them in the interest of time, but I'll go through as much as I can. But nonetheless, the PowerPoint presentation will be forwarded to our audience. I'll start with the standard. We call it, my colleague once called it, Shell Happito calls it the fatigue test. So I'll talk about first pressure or inflation, then I'll talk about trabajo or employment, and then of course I'll speak about kita or GDP growth. I'll speak briefly about finance if there is a time. This is probably I might have to skip for time's sake. I have brief slides on public and private finance, although my colleagues, speakers after me will be speaking of private finance. Then I'll go brief on the COVID. So the February inflation is 3%, and so we look at it, how good or bad is it from historical perspective. What are the causes? And basically what I have here is our inflation the past 50 years. And you'd see here is shocks are usually externally driven or supply side. For example, this spike here was caused by the first oil crisis in 1972-73. And then you have the second oil crisis. This is the case of the Iran crisis. And then I have this in blue to indicate that this is self-inflicting. So this is now the Philippine debt crisis. And then the global recession due to Kuwait. So another that has to do with oil. Then you have the Asian financial crisis. And then the worst El Nino in the past 20 years. And then we have the Iraq war and value-added tax. Again, it's external shock and its cost, its shock mainly is on oil. And then you have the global financial crisis. And then this is self-inflicting, our shortage in rice. And finally, the last one, small spike as it be historical perspective, is the African swine fever. You'll see that inflation trend have been milder through the years. It's been going down. It's been going up and down, but generally speaking, the trend has been going down, and the extremes have become less, though not necessarily in the present administration. So this is what's happened during President Marcos's years, inflation going up to as much as 50%. This is what happened to President Corazon Aquino years. This is what happened during President Ramos years. And then, of course, this is President Gloria Arroyo years, and then President Pinoy years. And then, of course, the present. So that right now, so far, the first 2 months, we have had inflations of 3%. So that's good. It's on target, but we might see some problems later on. Inflation, once again, is 3%. It's a slowing inflation thus far up to February, and that might reverse course. The main reason for that previously was the African swine fever, but that's gone now. So what goes up must come down. It used to be 6.6% last year. Now it's down to 1.2%. And then the main causes of inflation you would see has to do with with oil, with the global price of oil going up from $66 US dollars per barrel up to yesterday $111 US dollars per barrel. So how important is the oil? You would see here that, basically what I'm saying here is per 100% increase in the global price of oil, it has a pressure of 1.5% on our inflation. And of course, what's happened to the Dubai crude the past years, you have inflation of 6.7% in 28th of October. And then the COVID drove $23 per barrel. And last year, you have $65 per barrel, and yesterday, 2 days ago now, $110 per barrel. So precisely for that, the inflation that's 3%, by next month, it might start to spike again up to 4%. So that the average would probably be 4% the rest of the year. That is, of course, assuming that the price of oil remains at $110 per barrel the rest of the year. Now I go to unemployment. The unemployment, the last data was December. It was 6.6%. Just a perspective, there are 111,862,000 inhabitants in this country. Of course, 35,739,000 are younger than 15 years old, so they cannot be part of the labor force. That leaves us with 76,123,000. Then you have non-participants, 26,577,000. Of course, if you are a college student and you don't work, you cannot be classified as either employed or unemployed, but you are a non-participant. So that leaves us with 49,549,000, and that gives us the government statistic of 65.1% labor force participation rate. That's the official data right there. That 3,272,000 are looking for a job and cannot find a job, and that is the official statistic of 6.6% unemployment rate. That is the 6.6% of the blue and the green together. This leaves us with 46,274,000 or 93.4% employment rate. That's the official data right there. But then, of course, not all of them are, in a sense, normally employed. 6,811,000 are underemployed, and that's the official data of 14.7%. Not taking anything for granted from our audience, I'm sure many of you know what underemployment is, but underemployment is it's either you work part-time, so you are employed but not enough income, or you work over 8 hours. For example, many vendors are underemployed, working 10, 12 hours a day, but earning not enough. So that leaves us with 39,463,000 normally employed, for lack of term. So that leaves us with basically 40 million, 4 out of 11, 4 people feeding 11 people. What's important here is the OFW are non-participants in this economy because they are abroad, and there are 550,000 of them as of last data. Usually that's 2.1 million pre-pandemic. And that's an indication of this is something that we would recover when the pandemic ends. Statistically speaking, using November to December data, so the unemployment increased from 0.1% from 6.5 to 6.6%. Underemployment decreased by 2% from 16.7 to 14.7%. In headcount, of course, labor market has 910,000 net new participants. So these are the 910,000 with 797,000 finding new jobs and 113,000 now classified as unemployed. 806,000 quality jobs were produced. 806,000 quality jobs were produced, absorbing the 797,000 net new jobs plus 9,000 previously low quality jobs. I go now to income, so I know to the GDP, how the economy functions. Well, the GDP grows by 5.6%. The GDP now and the last 20 years, the GDP now and the last 70 years, and the business as usual benchmark or base case scenario. This is the past, this is this century. You would see here a slight spike during the presidential election, and then the global financial crisis causing a slowdown. And this is another presidential election causing a mild spike. Then the all-corrupt tightening of President Aquino years. That's it. All projects were stopped, presuming that every project by government set was dubious. Then a sudden, a mild spike in the election, leading to the election of President Duterte. And of course, this is the COVID-19 pandemic, and then presidential election coming up the next 60 days. From a historical perspective, the last 70 years, so this is now the debt crisis leading to EDSA, and now this is the COVID-19. which means that what we're saying here is we live to see the day that the economy saw its worst performance. This is now your business cycle of the income. That means this is what I have in red is what the growth would be in normal. If we do the same thing over and over again, nothing extra, we just show up every day, 9 to 5, the way we do it. So you'd see 2021, there was no surprise. It would have been 5.7%, the business cycle, but it actually grew by 5.6%. So a very small miss there in that case. The base effect for 2022 will continue. The first quarter, 7.6%. The steady state is the normal growth of the economy. Anything about 6.3%, that means the economy is growing faster than usual, and anything lower than 6.3% means the economy is growing slower than normal. So 6.6%, so that by the end of the year, our economy will grow by 6.3%. So the rest of the year will continue with the cycle. The annual growth will come from mainly accommodation, the recovery. You'd see here the 20%, 12%, 11%, so double digit most of the way, and also in construction, double digit growths. What I have here is the number of years each sector doubles. So the fastest one is construction, with the size of construction doubling in 7 years, and the size of finance doubling in 8 years. Of course, the one that's slowest right here is agriculture, doubling in 50 years. So no significant deviation in business cycle, and this is now the expenditure as opposed to income. You'd see here the export and import double digit, which indicates that the economies in terms of goods are opening up, but not the primary income. As you see, not primary income is still negative on the first quarter, which indicates that the movement of labor, the movement of human labor is not moving just yet. Consumption and investment will further accelerate the rest of the year. So it's going to be run by consumption, 8.7, 7.7, so on. And investment, double digit from the first quarter to the second quarter. What I have here in dots is what the economy would have been if there had been no crisis, if there had been no COVID. And you'd see here that this is what actually happened. And what the red here is where we are trending right now. And you would see that the slope of this line and the slope of the dotted line are the same, which indicates the growth rates are, the growth rate will be the same as before. But then again, there is, so the growth rate will be normalized now, but there is a level loss. This is now 3 trillion pesos permanently lost because of the pandemic. So I go slightly with finance, no dramatic change in the exchange rate. This is the gross international reserve. This will be the import cover. I'll just go through them very quickly. So it peaked at $10.108 billion, the gross international reserve, in $12.6 billion in 2020. Now it's steady at $10.108 billion, which is equivalent to 10.2 months of import. This is now the exchange rate. It's currently at $51 per barrel, but we expect no dramatic change in the foreign exchange. This is the debt. So this one probably I'll go through a bit slower. So it looks like I have time. So you see here, as the debt grows to 8.2 trillion, it's been growing through the years. But what happens here is the debt to GDP ratio has declined to 42%. So that the story is, prior to the pandemic, we did not pay or eliminate the debt. We just had to outgrow it. Our patron, John Gokongwei, we say to tell our students, if Mr. John had balanced his budget his entire life, there would not have been a JG Summit. You have to borrow. There's nothing wrong with borrowing. You just have to outgrow what you're borrowing. However, because of the COVID, the debt increased to 11.7 trillion, raising the debt GDP ratio at 60%, which is above the IMF threshold at 60% and below the controversial Reinhart-Ruger threshold of 90%. That is, well, we can talk about in the Q&A. This is the domestic debt. So as a debt to GDP, as debt increased to 5.4 trillion, historically the debt to GDP ratio had declined to 28%, but that story reversed. during the global financial crisis. Good thing that's domestic debt, but if we look at the international foreign debt, the story still holds. As external debt to gross to over 3.6 trillion, the external debt to GDP ratio declines to 18%. So we've been outgrowing our international debt, our foreign debt. So the story remains, no need to eliminate the debt, you just have to outgrow it. This is finance, so our colleagues will be more knowledgeable of that. So it's just one slide, but in the year we are at par with the rest of the ASEAN 5. You see here, this is what happened before the pandemic. You have the total trade peaking at 13 trillion and then going down to 10.6 trillion pesos. And now it started picking up. It's now 12.1 trillion. So as the economy opens, imports and exports will expand. And as we know, import and export equally, not equally, but they both create jobs. So that's the key. This is now the case for our OFW. You would see the need for the economies to open. So this is 2020. But as we reopen, as the rest of the world reopens, the deployment, if you can imagine, if we go back at least half of that would create a lot of jobs for our OFW. In tourism, contribution to GDP is 13 trillion pesos, or equivalent to 12.7% of the GDP. The contribution to employment is 5.71 million, or 14 of every 100 employed workers in 2019. And with all of that, you'd see now that the pandemic across the world have been declining. The cases of COVID around the world has been declining. So in other words, in closing, I suppose that there are 450 million cases, 66 million deaths, but the downtrend across major regions, so that of course, unless there is another sort of like a variant, but all else being the way it is right now, the COVID cases, the pandemic has been dwindling down. So in closing, there's opportunity in growth. As the world economy is open, international trade will expand, export and import, both creating jobs. The movement of labor will recover from pre-pandemic, and then the job prospects for tourism. The threat, of course, is inflation due to oil. So what's happening in Eastern Europe is something that we should look out after. And all said and done, we might be seeing the end of the tunnel. So thank you very much for having me. So I'll take questions later on this afternoon.
Okay, thank you so much, Dr. Dumlao. Of course, insightful discussion as always, and quite staggering graphs you have there on what could have been. But like you mentioned, a lot of opportunities for growth still, and some stabilization as well in terms of the pandemic. Still a lot of risks on the table. I think that's going to be the focus of the discussion later on. So we're going to be having you later on to answer the more pressing questions, especially when it comes to the oil prices and inflation.